You are listening to Keystone's Stock Talk Show, episode 261. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again. I will kick off the show this week with a review of a couple Canadian M&A deals over the past week, including a bid for a company from our Canadian focus buy portfolio, aerospace product manufacturer HRX DevTech, symbol HRX on the TSX, which has produced a 79% gain with the takeover bid for clients. I will also review the bid for steel producer Stelco Holdings Inc., symbol STLC on the TSX, and why Canadian small cap stocks may be ripe for continued M&A activity. In our Your Stock Our Take segment, Brett answers a viewer question on Valeura Energy, symbol VLE on the TSX, an oil and gas exploration, development, and production company focused on Thailand and Turkey. While it faces a near-term challenge and the geopolitical risk is higher, the stock is up over 100% over the past year and has a cash-rich balance sheet and relatively reasonable valuations. Brett will give you his take on the stock. Finally, remotely, Aaron answers a viewer question on goeasy Limited, symbol GSY on the TSX, a company which clients should be familiar with, as it continues to be a stellar performer in our Canadian income stock research. goeasy shares have gained over 70% over the past year, and Aaron lets you know whether we have a buy, sell, or hold on the stock. All right, let's get to the show. My co-host, Mr. Aaron Dunn, has filed his segment remotely, but I do have the Killer Bees, Brett and Brennan, with me today. How are you guys doing?
Doing well.
Doing good.
Brennan, yeah. You've got a new mic. Looking good on you. You're copying
Joining
me.
The club.
Clearly. Yeah, you finally. Aaron's got one too. Does Brett have the same mic? Or?
Yeah, I do.
Yes, we all feel similarly ridiculous with our giant mics, right?
Yeah, well, enough people were complaining, Brennan's too quiet. You know, we want to hear his expert opinion on all these things. He's just too quiet. Yeah. We can't hear him. Get him a new mic.
Shut that Brennan up. He's too loud, right?
Did he know is I was just lowering his volume the entire time.
It's true. Fair. Yeah, I can see that. Well, we're going to get right to it. There's some M&A coming in that we're going to talk about in a second, but we did have a poll question, and Brett's going to review that for us today. It was kind of an interesting poll question. We had some interesting responses, did we not?
Yeah, we had a couple responses on it as well, which we can talk about as well.
Yeah.
So the poll was, how important are dividends to your investment decisions? 27% said very important, 37% said somewhat important, 25% said not very important, and then 12% rounded off with not important at all. So the first comment I guess we can go into is they said they focus on growth as opposed to income, as generally those types of stocks don't pay substantial dividends and they don't create a taxable event. That being said, if the company is profitable and growing, that it's a prime mover. So in other words, prefer growth over dividends, I would say.
It's true. I think, there's definitely a point to be made there. But for us, some of the most successful investments we've made over the long term combined, I think that thinking kind of harkens back a little bit to thinking that there's just dividend stocks and just growth stocks. You can have, a combination, which is a dividend growth stock. And like we've seen that with Boyd, we've seen that with Hammond Power, seen that with a number of companies, Dynacores, those are companies from our, great returns that have produced, two of them have produced returns of over 10,000%, and they've increased their dividends significantly over time. When you have a company that can increase and grow that dividend over time, what it tells you is they're growing their cash flow and they're paying out typically more of that. It doesn't have to be more. It can be the same percentage over time, but that cash flow is growing and they have a discipline to continue to pay that dividend over time. They're continuing to pay that cash flow. And the only way their dividend is increasing is because their cash flow is increasing. So you've got the growth element of the stock there as well, because earnings per share or cash flow per share are increasing and you're having that dividend. So in that case, I don't think it's a black and white issue. I think you can have a great, what we call a dividend growth stock, and it can be a tremendous performer over the long term. And we've seen that not just in theory, we've seen it happen in practice in many companies that we've recommended. And those aren't just the large cap or in the dividend stock research that we do. The two stocks I mentioned came from our small cap growth oriented coverage. And again, you're talking about 10,000+% returns in those companies who have married dividends and growth into a dividend growth stock. So that's a sweet spot for us, and we'll continue to look in that area.
Yeah, like I had a professor in university who ended up telling the class that he will never, for his own portfolio, buy a stock that doesn't pay a dividend, which, I mean, again, you're going to be missing those potential capital compounders that aren't. I know it's just, and at that time, being a very young investor myself, and I'm just like infatuated by growth. I'm just thinking, what is he talking about?
Diamonds in particular.
No, definitely not. But, more looking at, just, these kind of like crazy growth stories, again, before I was with Keystone, before, these kind of headline stories or headline growth that you maybe kind of want to stay away from to some degree because you're, paying 100 times earnings or whatnot. But, so I was definitely on that side of the spectrum. Over the last 5 years of my life that I've matured some, I've definitely came to understand how much I love dividends, because even if a stock isn't doing the best in a certain period of time, it's still paying me, and there's nothing like getting checks just instantly deposited into your account every quarter of a year or every month. Obviously there's some dividend payers that pay dividends every month. So I've definitely warmed up to dividend payers. But again, my long-winded answer here, like Ryan said, is, you kind of have to have the balance of kind of the best of both worlds. And some companies do the best of both worlds themselves.
Yeah.
Like Hammond Power's, effective yield over like the last few years, it's absolutely tremendous now. I think, what is it, Ryan? 25%.
Yeah, it's gone from, just 4 years ago, in the 5-6% in that range up to like 18 to 20 something percent. Yeah,
exactly.
Now, two things on your comments there. You started with professor and investing is often a bad marriage, to be honest. Even if they know anything in theory, they're not always the best investors. I've found that. It's anecdotal. I'm sure there's some great professors that are investors. Number two would be statements that are absolutes are silly. Like to say, I would never do this. Well, do what you want in investing, but have somewhat of an open mind, have a criteria. But I think that what people really hurts people in their portfolios is thinking dividend stocks are for here, growth stocks are here, and there's no in between them. And there's definitely an in between. And if you look at, like, we put up stats all the time. RBC has this study they did, about a 30-year study, and the outperformance came from dividend growth stocks. Like, out of all growth stocks versus stocks that don't pay a dividend, stocks that have cut their dividends, and no dividend, all of this across the board. And the winner over like a 30-year period was dividend growth stocks. So you're talking about looking for great returns. The growth stocks that didn't pay a dividend actually underperformed the dividend growth stocks over that period. So, it's you look at the data, you look at what works for you in your portfolio as well.
I guess then we can lead that into the next comment. Was people need to Google the dividend irrelevance theory, which was 1961 theory from Miller and Modigliani. They got a Nobel Prize for their work in capital structure theory. Both of them did. And pretty much all it says is dividends don't create higher returns versus non-dividend payers, or dividend payers vice versa, that are irrelevant in predicting total returns for stock market. And I'd just like to remind people this was in 1961 was when it was published,
Yeah.
so they would have been doing it a couple prior years. So empirical data driven from actual stats, really wasn't significant at the time because obviously you were doing stats by hand at that time. I could run thousands of times the data that they could in a day very easily, in probably 20 minutes if I wanted to at this time. So there's now in modern day, you actually have quite a bit of pushback on these theories because you do have more data that is driven. So just first off, they're economists. They assume the markets are efficient, so there's no taxes, there's no transaction costs, and so on, which obviously isn't true, and that's always low-hanging fruit. But then there's a couple other pushbacks on this theory. One is signaling theory, where strong management, they can signal that the company is strong by issuing a dividend and saying, we have the cash flow, we can issue a dividend, and we have a strong company. Then another one is, these are only a few, there's a lot of pushback in by various people, is that if their paper was focused on either all dividend or no dividend, so 100% payout ratio or 0% payout ratio. But then if you're at 100% or 0% payout ratio, you might be taking on projects which have poor return on investment. Management's forced to acquire, the forced to invest their capital in things which they might not otherwise if they didn't have to reinvest. And that's another pushback. There's a ton of pushback in various places. And another thing which I found interesting, because I was looking into this over the weekend, is dividend payers within mature markets of Canada, the US, actually have lower volatility on average than non-dividend payers. But then in developing markets, which are already riskier normally, what they are, or emerging markets, dividend payers actually have higher volatility. So if you're going by modern portfolio theory, you can look up the Sharpe ratio effectively. It says the return premium over the volatility of the asset. It uses that ratio to really rate the actual return of a portfolio. So if dividends are relevant and returns are the exact same, but volatility is lower, that should be the better asset you would prefer just on that if dividend relevancy held completely true. And that was based on empirical data. I looked up probably a dozen different papers. So yeah,
Yeah.
that's
And
the 2 cents there.
no, it's good. And some, to also, to go back to one of the comments that we got, looking at growth stocks. I mean, there's certainly a number of growth stocks out there that shouldn't be paying a dividend. They should be reinvesting. They're growing at such a high rate. They should be reinvesting back in the business, and they can get a higher return on that capital than you can just paying out a dividend. They can do more with that than if it's given to you, essentially. And they shouldn't be paying that. But there are many companies out there that have excess cash, right? And they can grow. They have all the growth capital they need to grow the business, and they can return to you and grow that over time. And that it can be a great marriage and can produce a great dividend growth stock. So I think that the category of marrying the two is there, and it's just not talked about enough. You have dividends and you have growth stocks, and there's nothing else. Well, that's not the case, and you're eschewing a group, and just by not looking at a stock because it pays a dividend, or not looking at a stock because it doesn't pay a dividend, you're eschewing. But if you're not looking at a stock just because it pays a dividend, you're eschewing that group that can grow with the dividend, and grow that dividend as well. So that's our soapbox for this week. It's an interesting topic. We'll continue to look at it, but there are some, like Brennan said on Hammond Power, it's very sexy to wake up every year and get paid 20%. Like if you bought Hammond Power 4 years ago, you're getting, or it's 4 years ago in that range, you're getting about a 20% dividend every year on that stock. Plus the stock is over that period has gone up almost 1,000%, right? So you get that, but if it just sits there for the next 3-4 years, you're getting 20% a year just on your effective yield if you bought it 5 years ago. Okay.
Yeah, exactly.
Hopefully that makes sense. Let's move on. What I'm going to look at today is activity in the Canadian markets, M&A activity in particular, and whether or not the small to mid cap area of the market is ripe for M&A. We did see two acquisitions over the past week, or takeover bids come in on HRX on the TSX and STLC on the TSX. They have takeover bids for them that were put in the last 5 days. So let's just look at these takeover bids first. One of them comes from a company, HRX DevTech HRX on the TSX. This is a company that's been in coverage for about 5 years. The company has, on this takeover bid, made a gain of around 79% for our clients. The stock price is now $31.02, market cap around $1 billion, doesn't pay a yield, doesn't pay a dividend. What does the company do? The manufacturer of aerospace products. In fact, they're the third largest landing gear manufacturer in the world. The company serves both commercial and defense sectors. HRX also manufactures hydraulic systems, fluid filtration systems, and electronic enclosures operating across 15 locations in North America and Europe. As we can see here, strong performance over the past year, up 106%. Now, let's look at the transaction details. That's really buoyed the return there. It's done well this year, but buoyed by the takeover bid, and that came in. Let's look at the details on that. They agreed to be acquired by Platinum Equity Advisors, a U.S.-based private equity firm, for $32.50 in cash. That's a 28% premium to the closing share price on July 10th, 47% premium to the 90-day volume-weighted average, 79% gain, like we said, from Keystone's original recommendation price. Let's look at the valuations on acquisition. Currently trades for a PE of around 27 trailing, EV to EBITDA of 14 times trailing, and price to FFO of around 13 times. Forward looking is about 22.69 times 2024 expected EPS. Quickly here, our conclusion. Valuation is, this takeover bid is relatively fair in our opinion, given the debt levels of the business. The current discount to tender price is around 4.8%, with an expected closing date on or before March 31st, 2025. Keystone rated, we shifted our rating to tender or sell. We take the 79% gain and recycle those profits into new focus buy recommendations. All right, let's look at the next Canadian stock to receive a takeover bid over the last week. That company is Stelco Holdings Inc., symbol STLC on the TSX. 65.61 is where it trades today, about a $3.6 billion market cap, has a 3% dividend yield. Stelco is one of Canada's leading steel producers, operating out of two facilities. Lake Erie Works near Nantico, Ontario, and Hamilton Works in Hamilton, Ontario. The company's rolling and finishing capabilities enable it to produce not only hot rolled coil, but also value-added steels such as coated and cold rolled steel. So let's look at the stock price chart over the past year, up around 39%. Most of that gain, in fact, more than all of that gain, actually comes from the takeover bid that it received. Let's look at those transaction details. Stelco entered in a definitive agreement to be acquired by Cleveland-Cliffs for $70 per share, consisting of $60 per share of cash, 0.454 of Cliff shares. Cliff trades on the New York Stock Exchange. We'll get to that in a second. The takeout price is an 80% premium to last Friday's closing price and a 37% premium to Stelco's pre-announced 52-week high. The agreement allows Stelco to terminate the transaction and accept a superior offer subject to a customary right to match in favor of Cliffs and a termination fee of about $100 million. Now, Cleveland-Cliffs Inc., symbol CLF on the New York Stock Exchange. They're publicly traded, largest flat-rolled steel producer in North America. Let's look at the valuations on the transaction. Based on current forecast, the implied takeout multiple is about 6.5 times EBITDA, 16 times EPS, approximately, on a forward-looking basis. Fair value, in our opinion, given the volatility in steel prices and steel markets generally. Our conclusion here, the Cliffs deal will likely proceed. Stelco has received shareholder approval from large shareholders, including Fairfax, a gentleman, Alan Kestenbaum, and Lindsay Goldberg, and the executive team, who all control around 45% of the outstanding shares. Further, the transaction has received support from the United Steelworkers Union. They're workers here, and there is a chance a superior bid that is not matched by Cliffs could materialize, so holding through the bid period expires at least is advisable. So with 2 takeover bids out there, we are being asked if this activity will continue and if Canadian stocks are being targeted in M&A activity, and why would Canadian stocks be targeted over particularly some other stocks, or North American stocks, US stocks, European? Well, we've seen a pickup in M&A activity in the Canadian markets generally. Now, generally speaking, M&A has been depressed for several years after rates rose and capital became more expensive and harder to access. We do see Canadian companies potentially being targeted, and it may actually be a good strategy. You can see here the performance of major North American indexes over the past 5 years. The laggard here is the Toronto Stock Exchange. If we included the TSX Venture, it would have been an even bigger laggard at the bottom of that list. If we look over the last year, a similar scenario unfolds, with the TSX being the poorest performer. Generally, valuations are more attractive on the TSX, and it appears some larger US companies are taking advantage of this. We'd expect that to continue. For example, if you look at the S&P TSX, the Canadian market is trading at a PE of around 21.8. The S&P 500 PE right now is about 27.45. Now, a number of clients have reached out in our weekly chat sessions via email in the wake of the HRX premium takeover bid, and inquired as to what stocks we believe could be the next companies acquired from our buy recommendation list. Now, for decades, we have experienced great exit points from stocks that we recommend to clients and have invested in ourselves. We have seen this over the past year, like we said, in a name called, or a name like HRX. Also, H2O Innovations was acquired. We expect that trend to continue through 2024 and into 2025. One of the items that you also may have noticed on that list was the second laggard of the 5 exchanges listed there over the past 5 years was the Russell 2000, often considered a larger US small cap index. The valuation gap between large and small cap stocks remains at 20-year highs in favor of small cap stocks. So we believe a number of solid small cap stocks are primed for takeover bids over the next year. Now, predicting which stocks will be acquired is a fool's game. Look for a profile. This is what we do, of good businesses with solid revenue and profitability and reasonable valuations. That will lead you to companies in your portfolio that can be acquired and provide you an exit point. We see potential M&A activity generally in specialty Canadian pharma, aerospace and defense, software, gold, and the energy segment. So there's a broad range there. You're looking at that profile within those segments. It's something we expect to continue to report on through 2024 and into 2025.
Yeah, I was just pulling up from the Institute for Mergers, Acquisitions, and Alliances. I'll just share my screen here real quick. So this is directly from their website, and it's just basically saying that, let's see if I can zoom in here a bit for you. But yeah, essentially, so in 2023, there was about, again, this is for Canada, there was about 2,648 mergers or acquisitions, where this year we're looking at about 2,478. So, I mean, they're expecting, it still to be down from 2023 in 2024. But again, it does seem like, companies are starting to get maybe a little bit more opportunistic in the market environment that we've seen over like the past, or compared to what we've seen over the past, year and a half.
And we'll see if they're wrong by year end.
Exactly.
Yeah, it's definitely picking up. And I do believe if we combine those two things, the fact that in Canadian markets generally, you're getting a lower multiple for the markets generally, plus small cap versus large cap, the valuation gap is at 20-year highs. Typically, to give listeners, viewers, an example of that valuation gap, small caps have actually over history been valued higher because of their inherent growth potential is higher typically than larger cap companies. So you've seen an inversion of that, and you have the potential to see it flip back to more historical norms over time. So that's why I think you're seeing some potential more activity, and why you could see these smaller companies, smaller Canadian companies targeted. And there's a couple mid caps that kind of got targeted over the past week. We'd expect that, it can continue going forward. There's also, a little bit more enthusiasm in the market. If rates are coming down, you could have cheaper access to capital. It's still a more difficult environment than it was, a few years ago, when money, was basically free. You're getting it at such low rates. You're not going to get to those highs that we got to at that point, but is it picking up? It's certainly picking up. And I think you could see some targeted buys within the Canadian small cap arena.
Yeah, I think it extends as well to do with specific industries. Like we saw Hero DevTech being aerospace. The entire industry was so beaten down with the pandemic, and they didn't really get that same 2021, 2022 just run up as other stocks did. They were still trading quite weak. They were depressed at best, and their multiples only in their earnings as a whole really didn't recover until 2023. So we're not now seeing them really return to that pre-pandemic valuation. And since growth is expected, now you're starting to see them trade at multiples. So you're seeing Hero DevTech. We have another aerospace tangent related company in our coverage, and it's went up similarly, I think 100% since pre-pandemic, or more than that even, and 3 times since its low, 4 times since its low valuations. And that just shows if companies are looking to acquire, they have the capital. If you're seeing interest rates go down for those industries which are still relatively low valuations compared to other companies, as they didn't get that big run up, they are appealing.
Yeah. I mean, and you've been able to check off some boxes. Potential buyers have now seen who's going to survive, who is looking. You've had a couple quarters in a number of these companies, even a year at times, where they've had great growth year over year and are projecting good growth. You see backlogs come up significantly. The company that you were just referred to, the aerospace and defense company in our coverage, still outside of HRX, has had reported record backlog, good solid earnings and cash flow, and had, moving into a net cash position once again. Those are the type of companies, if people ask us who we think should be taken over, it's that profile. And then you marry it with an industry that was depressed and has some tailwinds potentially at its back going forward. That's why you see a company like HRX get acquired, and why we could see a couple other companies that are in those segments. Specialty pharma was depressed for a while too, and that's why I kind of highlight that segment. And there's always, you see the price of gold where it is right now. You haven't seen a ton of increases generally in some of the gold stocks relative to where gold has gone. You could see some M&A activity if they start to pick up over time as well. All right. I think that beats that segment to death. Let's, if there's any questions on that too, and if anybody out there has any companies they think are ripe for an acquisition, why don't you send those in and we can review those and see if they match our criteria for an acquisition, and we'll take a look at those. All right. I think we're going to move on to Brett's segment. You're going to look at an interesting company, an energy-related company, Valeura. How do we say that? Do we know how to say it?
Valeura is how I was. Yeah, we're probably saying it wrong, and I will blame Ryan for that.
You should.
Neither me or him can ever pronounce names, and that's
true. It's just great to go with symbols. That's why I always try to say the symbol, because I can actually pronounce letters. It's impressive.
Sometimes.
That's true. So let's get to that. And it is an interesting company within the energy sector. We've been looking at it for a while now, and it has a good cash-rich balance sheet, which in this sector is essential. Often you see companies levered up, and it looks good when oil pricing is at your back. When it's not, it can really get ugly, and you need some money in the bank for a rainy day in this segment.
Yeah, so Valeura Energy, symbol VLE on the TSX, is an oil and exploration development and production company focused in Thailand and Turkey. Currently, the production is offshore, based in Thailand. After the company sold its shallow conventional gas business in Turkey in 2021, they do have a remaining asset there, but it's not in operational state right now. The company underwent a major transformation in 2022, shifting its focus to Thailand in the Gulf of Thailand. The company operates in 4 offshore oil fields. The stock is trading up about 100% over the past year at $4.20 a share, with a market cap of $450 million. So great performance over the past year, like many oil and gas companies, with the price staying quite high. Looking at the operations in the Gulf of Thailand, the Valeura and Jasmine fields are midlife, while the Nong Yao and Wasana fields are actively undergoing expansion and exploration. The company has 37.9 million in proven and probable reserves at this time. Combined, the fields are expected to produce approximately 23,000 barrels of oil daily in 2024. During Q2, with its preliminary results, the company produced 21,100 barrels of oil per day. I got that one, Ryan. Don't you worry. The company is expecting, however, a 50% production bump for the Nong Yao field within 2024, providing a significant portion of the organic growth for 2024, exiting the year at approximately 11,000 barrels of oil per day. I will note, however, the Wasana mobile offshore production unit has been found to have a crack in it, which puts the current production at 17,000 barrels of oil per day at this time. The crack may be superficial, which means there's really no risk to the structural integrity, and that results in a shorter turnaround to production. If it is structural, it will need repairs, and that obviously takes time. The company expects to know the severity by the end of July, and if production can resume or if they do need to repair. For 2024, the company is expecting production of 21.5 to 24.5 thousand barrels of oil per day, a 13% increase year over year from the midpoint. The company's oil benchmark they use is Brent, but during the last quarter, it is notable that the company actually did have a premium over Brent of $2.70 over that benchmark oil. The current guideline implies a netback of $45 per barrel after expected royalties of 13%, operating expenditures of $220 million for the year, a flat G&A of $25 million, putting the annual netback at about $378 million for the company. Looking at the preliminary results for Q2 24, which we'll be going off of primarily, as the oil production, obviously, you do move. So a lot of times you do rely on these preliminary results more than like a manufacturing company, which you wait for the quarter. And most of them don't even release some sort of preliminary results, if anything at all. So oil production was 21.1 thousand barrels of oil per day at a realized price of 87.7 per barrel, resulting in revenue of 164 million. The company closed out the quarter with 145 million in net cash after having a combined outlay of 109 million for taxes for the prior year, the purchase of the Nong Yao floating storage and offloading vessel, and its final contingent consideration for the acquisition of Chris Energy. At 145 million of cash US or 199 million in Canadian, with no debt past, they do have leases, but no financial debt. The cash is roughly 44% of the market cap. So cash rich, to say the least. And like Ryan was saying prior to my segment, it is rare to see an oil gas company that is actively exploring with such a strong balance sheet. Many of them have, over the past couple of years, with the higher price of oil, have started to move into cash or at least less net debt. But this is at 44%, very substantial and an outlier even when it comes to the improved financial condition of oil companies over the past couple of years. So switching to valuations, looking at an external analyst expectations, the company is trading at only 0.2 times EV/EBITDA, which is quite cheap to say the least, due to the high cash balance, than the expected strength in EBITDA over the year. And of course, they're accumulating cash throughout the year, lowering EBITDA enterprise value even more. So if the current oil price is staying the same, they're able to retain the same net back. It's looking quite cheap, to say the least. However, there are some risks to do with the company. The Valeura and Jasmine oil fields are midlife, and production has been trending down for multiple years. The company can extend the economic life with infill wells, but ultimately other production sources need to be found to keep at the current levels, or they sell off those fields rights and move into different ones. They invest in their Turkey asset and so on. They need to do some sort of capex to really replace that production level. That's the same as other oil exploration and production companies, but they do have significant assets that are midlife and they are trending down. Near term, the company is also seeing lower production due to that Wasana crack in its offshore facility, which if it is structural, it will lower cash flow for the year as they will need to first they lose their production during the 2 weeks, the 6 weeks, depending on how long it takes to repair and how long they're waiting with production offline, whether it's even superficial, that'd probably be 2-3 weeks from now, or 6 weeks, a month, 2 months, if they do have to repair. Plus, then they have to outlay cash for that repair if it needs to be occurred. So it's a lose-lose situation if this crack. You lose on the top line and you lose off of the cost which it takes. So obviously that's something you need to watch, and you'll see likely an update on the next couple of weeks. And of course, on top of this is the commodity risk with oil. I don't think that really needs to be said. That's throughout the industry, and that's why we always have to caution investors with oil companies, is it needs to effectively trading at a discount, and you can't compare it to other companies as it is obviously so related to the commodity. And as well, it does have moderate geopolitical risk operating in Thailand and as well as potentially Turkey again. They're not the highest risk companies, but they're not the lowest risk either. They're kind of middle of the line, but you do need to have that at a discount compared to other jurisdictions. If it was a U.S. producer, it needs to trade at a discount if it was the exact same operations. So concluding, if you really are an oil bull, Valeura appears to be appealing due to a strong financial position, which is further supported by the strong expected cash flows if oil prices remain steady or higher. The company is trading at an overall discount. While we would never invest for the expectation of a takeover, the combination of the valuation, the production growth expected in 2024 creates the potential for the company to be acquired. Like Ryan was saying in his segment, acquisitions are starting to uptake in the year, but you never really want to invest expecting one to occur, as it is out of really public information. You can't rely on it. You can look for the ones that can have the potential, like it is here, but you can't expect it to occur inherently. So overall, I would really say if you want to speculate on oil, Valeura is a method to do so. It is appealing. The valuation is low. You are taking on a bit of more geopolitical risk compared to other oil producers, but I think the discount and the strong cash balance sheet really overcomes that expected increased risk with the geopolitical risk.
Yeah, I think it's a good summary, and it is interesting. It'd be nice if we knew those midlife assets were long life assets, and then you'd have a perfect, not a perfect scenario. There's never a perfect scenario, but you had those assets, or they had assets that you knew were going to grow, and they were going to grow the production profile. So it'd be nice to see a lot higher level of growth in production profile, but it is an interesting company.
Yeah, one of the analyst reports that I did look at, they are expecting growth for 2025, and then 2026, then it starts to drop off after there a bit more.
Yeah.
And this really depends on the exact cadence of their 4 oil fields at this time. The Nong Yao field is really what's driving any growth behind it at this time, especially for 2024. So that's really where you'd see the organic growth, if anywhere.
And the good thing is, like, they have that cash balance, and they're as long as you keep generating cash flow and have, you're kicking off excess cash, they can make acquisitions, right? They can do that. And then you get growth by acquisition. You're never, organic growth, you're always fighting against it in the energy industry, right? Like, you're always fighting against wells deteriorating, production coming offline. So you're always trying to, we talked about to royalty companies in the past, and that's what they're always fighting against, even with diversified production, right?
Yeah, like if you compare it to like a manufacturing company, they really have an infinite life that they can expect, assuming the product is long lasting, where resources are finite. So you're really running against time for any production asset.
Yeah. All right. We're going to move to a segment that Aaron, I believe he taped this ahead of time, but he's going to do it on a company that we've had in coverage for a number of years now that's done tremendously well, goeasy. We got a question from a viewer, and it's a company we've had in coverage for years. Aaron's talked about it a number of times at conferences, I believe he's even talked about it on the podcast, but it's a company that's done tremendously well. And I'm going to let him take it away and give us the latest up-to-date news on the business, as well as our current buy, sell, and hold take.
Okay, so today I'm actually going to take a look back at a company that we've had under coverage at Keystone for several years now. And this company is goeasy Limited. The symbol is GSY on the TSX. It's trading right now at about $103, $3 billion market cap, and about a 2.6% yield. So what they are is they're an alternative financial services company. They primarily serve non-prime or subprime borrowers in 3 main business units. There's Easy Financial, their largest unit, which offers unsecured and secured loans, Easy Home, which provides lease-to-own furniture and appliances, and also LendCare, which offers point of sale consumer financing. So this company has performed very well over the last year here, over the last 12 months. As I said, about $183 right now, up from $120 12 months ago. Our coverage at Keystone on goeasy has gone back for over 5 years. So it was in May of 2019 that we originally recommended this company at a price of just under $50 per share. It's performed spectacularly well. Since that time. There's been some volatility around the 2002 period. A lot of that having to do with concerns about rising interest rates and how that would affect a company like goeasy being in the finance industry. But companies continue to perform well. So the reason why I want to talk about goeasy is we recently talked a little bit about some research that was done on the stock market and what are the contributing factors to excessively high returns relative to the market from companies. And the main factors tend to be companies that are profitable and that are growing their earnings per share. So when we first looked at goeasy 5 years ago, I'll have to admit, back then I had followed the company for a couple of years and I kind of dismissed it because I felt that the business of non-prime lending, unsecured lending was just too risky and I didn't really understand it, didn't want to be in it. But as I learned more about the company and looked at the company's track record, I saw something that was extremely compelling. And this is a company, first of all, it's a very entrepreneurial focused company, high management ownership. But this is a company that has got an almost unparalleled track record of financial success. So we looked at the company's financials going back 20 years. In every year, so for 20 straight years, the company was able to achieve revenue growth. And they were also able to achieve profitability consistently over that 20-year period as well. So we looked at how the company essentially was able to deal with shocks to the market. One of the biggest ones in this period being the 2008 financial crisis. And goeasy, based on the way that they manage their business, the way that they manage their risk, was actually able to maintain profitability through this period. So earnings per share did decline moderately during the financial crisis, but still strong profitability. And the financials were also very quick to rebound. So track record is something that we look at. Not every company is going to have a 20-year track record. Some companies are newer, and that's okay. It's not necessary that they have a 20-year track record. For some companies, there may be a change in their market, which is going to impact their financials in the future relative to how they've been in the past. And it's important to understand that. So there's a lot of factors that go into researching and recommending a company. In the case of goeasy, we were talking to management, we were looking at the track record, but also what was happening in the market at the time in 2018. So it's pretty phenomenal, though, that they were able to, given the business that they're in, maintain their profitability over this period of time. And then again, maintain the revenue growth. So right through the financial crisis, they were able to maintain their growth as well. And there have been other crises over this period of time as well. More regional shocks. There was the downturn in the oil industry in Alberta. They've experienced a couple of those. But through that, the risk management process is really what we were looking at. And that risk management process was able to avoid a lot of the, what a lot of people would have expected would happen to a subprime company at the time. And they were also able to gain market share, given that they were in a strong financial position. So this is really what the base of our investment strategy at Keystone. The first thing we look at for any company, it doesn't matter the industry, it doesn't matter the theme, the trend, is this company profitable? Is there a significant amount of profitability and free cash flow coming from the current operations? And that is the very baseline, bottom level criteria for investment. If a company doesn't pass that test, then it's not something that we're interested in pursuing, even on a research basis. And then beyond that, we want to see that the company is able to grow their earnings per share, their revenue per share, and also do this without incurring too much debt. We want to understand the business model, the growth prospects. It should be an understandable growth plan that has a high probability of success. So these are the things that we looked at with goeasy. Now, since then, since 2018, the growth had actually accelerated. So 2018, it was about $3 per share in earnings. Last year, they made 14 per share in earnings, but consistent growth since that recommendation based on this growth strategy that I talked about and the research. And this growth is expected to continue in 2024 with analyst estimates in the range of about $17 to $18 for earnings per share right now. So growth is expected to continue. Looking for the key growth drivers of the company would be continuing to do what they're doing with the risk management and the customer service to gain more market share in the unsecured lending space. But they've also more recently entered into the automotive financing space. So that is a large market and a big area of potential growth for them. They've also come out with a new general purpose credit card. It's in development. It's not out yet, but this is in development. And this is supported by the goeasy Connect mobile app. So good, strong long-term growth drivers going forward. But another thing that I want to talk about with goeasy that made it attractive was the dividend. So the company did not pay a very high yield at the time, roughly around where it is right now. So I think it was about 2.5% when we recommended it. But just as the earnings and the revenue were growing, so were the dividend. So that growth in earnings allowed them to continue to increase the dividend and consistently over this period of time. So in over a 6-year period, they've been able to increase their dividend by a multiple of 5. So the current dividend this year is expected to be about $4.68 based on the increase at the start of the year compared to 90 cents per annum when we originally recommended it. So about 5 times growth there. And we expect that to continue, perhaps not at the same pace. The growth may slow somewhat, but we are continuing to target consistent annual growth in the dividend over time. And what we're really looking at, I mean, if you extrapolate this going forward, even at a lower growth rate in 5 to 10%, like just looking, our original recommendation price on the company was $49. It's now paying a yield of, close to $4.70 right now. So that's almost a 10% yield on that original entry price. And this is really kind of the way we would look at dividend pairs. I mean, we want to see a company that's paying a reasonable yield and growing that dividend over time. Now, sometimes they're starting with the higher yield and the dividend growth, while consistent, maybe, more in the single digit range. Other times you're investing in a company that has a relatively small yield, but they're growing it in the double digits, basically on an annual basis. So, but really it's dividend growth that we're looking forward to drive the performance for a lot of these companies. So just in terms of investment thesis on goeasy, it's a high growth specialty company with an unparalleled track record, 20 plus years, 90 consecutive quarters of profitability. They're maintaining their positive outlook for double-digit revenue growth in 2024 and 2025. They're also looking at continued margin expansion. They did a fantastic job. I mean, recently they've had to contend with the increase in interest rates. That has been a significant net negative for most finance companies, but they've continued to be able to grow through that. So that is, again, attributable to the risk management, high insider ownership, which we like when management is aligned with shareholders. It's about 23% insider ownership, and of course, trading at a reasonable valuation. So excellent track record, strong growth, strong profitability, trading right now in the range of 10 to 11 times expected 2024 adjusted EPS. So we continue to like the company. We continue to have coverage on it, and we will be putting out an update on goeasy when they come out with their Q2 results in August.
That's definitely, thank you, Aaron. That's a good summary on goeasy. Again, like we've said, it's a company we've had in coverage for a number of years, and I think you went through the business and the growth in the business. And one of the things that we kind of try to impress on investors is it has been a dividend growth stock. So the effective yield has gone up over time, which is great to see. But it's really the share price gains, like the capital appreciation that you see in goeasy. And it's, people talk about you to gain exposure to financials in Canada. You talk about having the big banks. Most Canadians invest in, the big banks. They own. We see many portfolios they own 4 out of the 5. You don't have to do that, but there are other financial services companies in the Canadian markets. goeasy is one of them. We have one that has had a tremendous gain for us in our portfolio over the Canadian small cap portfolio. It's a bank and it's just entered the US market. And it had a good day as we're recording this today. Again, not many investors know about that business. Not many actually knew about goeasy, particularly 5-10 years ago. But, great businesses that are kind of outside. They're in the financial services sector, they're in the financial sector, but they're not the big banks. And they're outperforming the big banks significantly. So, while we own maybe one of the big banks, there's the 6th largest bank we have a recommendation on too as well. But there's companies kind of that you get less coverage on, that you come to Keystone, you're going to get more coverage on those companies. And we're looking for outperformance in terms of those. And, all 3 of those companies have outperformed the big banks over the last 5 to 10 years. And that's what we like to see.
When you're looking at really any subprime financial company, people always too risky. It's going to just blow up. But then when you do have companies which can do it well, they can structure their risk and they can manage that well. This is why you get those returns, because they're able to get those higher returns off their loans and lending activities, versus then if they don't realize that risk, that's why you get that compounding, even if it's only squeaking out an extra % compared to a bank model. Once you're going over 5-10 years, it just multiplies drastically.
Go, Brennan.
All I was going to say is just, again, reiterate, what Aaron was saying about like the effective yield. It's paying just slight of a 10% effective yield now for people who bought it on our initial recommendation, which was slightly under $50. And when we did initially recommend it, it was paying a forward yield, I believe, about 2.5%. So again, just holding it, since 2019, which really isn't a long time ago, you're now making about 10% on your money every single year, as long as you still hold the stock.
Yeah, and we expect that to continue to go up over time. That dividend will increase, probably besting, the rate that you see an increase at a bank or the big banks. And of course, you've seen it go from $50 to 190 plus. Mm-hmm. So, there's your real gain. Yeah. But you're also, if it stays flat for a year, you're making, on the effective yield on the original investment, you're making 10% every year, which is excellent to see. All right. Again, I think that's going to end our show for this week. Keep your questions coming into our Your Stock, Our Take segment. We'll answer those on a weekly basis. We're very encouraged. We're getting more and more questions coming in. And like we said, if you think you have a company out there that's a takeover target and you want us to review it, we're never going to invest in a business because we think it's a takeover target. We want that to be a great business. And if we have an exit point because there's a premium takeover bid in a good business, it's great. But, if you have a company that you've identified that you think's a takeover, potential M&A target, let us know and we'll see if we can review it with that lens in mind. If you're watching me right now on YouTube, smash that subscribe button. If you're listening to this, consuming the podcast, wherever you listen to your podcast, rate and review us. As I say always, we are looking for positive reviews only. And I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.